The last 2 weeks has been a tough one for the stock market, but in today's market update, we are going to put that move into context and tell you what you need to know moving forward. Also, in mid-December, stock market sentiment was super bullish for investors, but today the opposite is true. Investors are super bearish, and that is a good thing. We will tell you why. And last, our rapid fire, we have 4 additional charts you need to know. Let's dive into it. So the last 2 weeks has not been a good one for the stock market, and we have seen the S&P 500 drop over 5%, the NASDAQ down over 10%, small caps down almost 15% from their highs. And this is never fun to go through these sell-offs, but at the same time, we wanted to put it in context. And so we have a chart that we're going to put up in just a second that goes and looks at the S&P 500 and the NASDAQ since the start of 2023. And what will you notice here is that over this whole time frame, the S&P 500 is up almost 57%. As you can see there on the far right, that is in blue. The NASDAQ, tech-heavy NASDAQ, which we have been big fans of tech over really most of the last 6 years, up 89% in that time frame. But yet, here's the important part. There have now been 5 separate sell-offs that have happened over that time frame of note, that have been of significance. The first one was in the spring of 23. This was the Silicon Valley Bank failing that took place. A lot of regional banks got hit very hard. The stock market, and by the way, in most of these declines, the majority parts of the market were down between 7 and 12%. Okay, that's very, very important. But that was the first one in the spring of 2023. The second one was in between August 1st and the end of October in 2023. This was set up by the Treasury Department saying they were going to issue over $1 trillion of Treasury bonds in the quarter. That caused interest rates to shoot up and took the markets down as well as bonds down as well during that period. The number 3 sell-off happened last year in 2024, early in the year, basically in April, and that was just a correction because the market had rallied so far off the low there, October of 2023, through the end of March. Number 4 was a pretty vicious sell-off last mid-July into early August. And we had several videos in that time where the S&P was down around 11%, tech was down 17%. It was a pretty vicious sell-off that happened. And then the number 5 sell-off is the one that we're in the midst of now. And so here's the thing. We believe this is just another garden variety sell-off, that there hasn't been any major fundamental change where a recession is imminent and the stock market could go down 20, 25, 30% or more. And here's the thing. These garden variety sell-offs happen even in good market stretches like what you see here, where the market's done very well. But each of those declines was not fun to go through and felt like a challenge, and you feel, hey, when's this sell-off ever going to end? But the fact is, it's very important to keep your composure. And look, that's what our clients have us for, is to help keep their composure. And in fact, begin to want to buy when you have these kind of sell-offs. But we wanted to show this to let you know that even though the market has gone down, it's still much higher than it was 2 years ago. So in mid-December, we did a video where we talked about the fact that the markets had gone up a lot over the previous couple months, and there were starting to be some signs of euphoria, a little too much excitement in the markets. And at the time, you had investors very, very bullish. And this doesn't make common sense when you first start thinking about it, it doesn't make sense. But we don't want to see everyone super bullish. And at the time, you had investors very bullish, you had fund managers very bullish, and at that time, everybody was on one side of the boat. We said a lot of times sell-offs can come out of nowhere when this happens, and that is exactly what has taken place. So this sell-off is not a surprise to us. take a look at investor sentiment now, because just 2.5 months ago, investors were very bullish. This chart you're looking at is how many investors are bearish, and this was very, very low. All of a sudden, this has skyrocketed in the last 2 weeks, and over 60% of investors are bearish right now. And take a look, over the last 10 years, this is right near the highest level of bears in the last 10, which makes no sense given that the market has dropped much, much less than it has at some other times in the last 10 years. For example, the fourth quarter of 2018, the market dropped almost 20%. When COVID hit and the markets dropped almost 40% in 4 weeks. And then in 2022, a very rough year where the S&P was down 28 and the Nasdaq was down 38. Over the course of the year. There were a lot more reasons to be bearish then. So this is a surprise that we have so many people so bearish. But the bottom line is, for investors, this is very good. We much prefer investors to all be over on the one side of the boat, very bearish, because a lot of times that's when you know the froth is out of the markets and rallies can resume. Doesn't mean they will always resume immediately, but we are very happy to see this, and you should be too. Now, one more chart to take a look at sentiment. There is something called the Goldman Sachs U.S. Equity Sentiment Indicator, where Goldman Sachs uses 9 different data sets and then it's a composite, shows them all. It's very helpful to look at. And one of the items that we talked about in that December update was taking a look at mutual fund managers on the equity side that were overweight equities at a very high level. Well, that's one of the items in this indicator. And by the way, speaking of that December video, it's very important, if you are not a subscriber, to go ahead and subscribe and turn on notifications so that you can see each of our videos so that you don't miss one, because it's very important to help put into context what's happening in the markets. But if you look at this Goldman Sachs indicator here, you will notice that on November 29th of last year, this was up at its highest level in the last 10 years, meaning very bullish, everybody pushing all their chips in on the markets. And take a look at the reversal that's taken place in just 3 months. It's gone from overweight, overextended, to now underweight slightly at minus 0.4. Again, this is just another piece of evidence in addition to investor sentiment that says the froth is gone out of the markets. Okay, now it is time for rapid fire. 4 charts that you need to know about. And the first one is taking a look at a bunch of the AI winners. When we had our 2024 recap, we talked about the fact that the king of AI, NVIDIA, had a great year last year, but most of the gains came in the first 6 months. And we talked about the fact that a lot of the AI names, a bubble had formed, and thankfully it had burst as of the end of the year. And we showed a chart taking a look at a lot of the AI winners and how far the stocks had fallen from their highs. Well, guess what? In the first month and a half of 2025, a lot of these names raced back up to their old highs. Not all of them, but a lot of them. Well, the last 2 weeks has been very unkind to these names. At the top, NVIDIA is down 25%. From their high, and that's a big deal because NVIDIA was the largest holding in the S&P 500, and it and Apple have gone back and forth over the last 4 or 5 months for who's the largest position in there. But when they drop 25%, that moves the markets. Dell Technologies down 25. GE Vernova, a power company that, hey, all these AI data centers, they need power. And so a lot of these power names skyrocketed. Well, GE down 31%. ARM Holdings, a chip maker, down 33%. Constellation Energy, another utility, down 34%. Palantir down 35%. Supermicro to 38%. MicroStrategy, now Strategy, down 40%, Vertiv Holdings 47%, and Mysterio Labs down 54%. And again, a lot of these names had skyrocketed before this. So A lot of the AI names, again, the air has been let out of that bubble in the last couple weeks. We're very glad to see that, but we're just letting you know that this is one of the things that have kind of led the sell-off over the last 2 weeks. Now, let's put up a chart of some good news, and that is the price of a barrel of oil, which today is sitting at just over $67. Listen, in early January, this was sitting at 80. And guess what? 67 is one of the lowest prices over the last 4 years. This is very good news for the consumer because listen, for those who drive internal combustion engine cars, which is most of us, this means gasoline is going to be a lot cheaper. But guess what? Even if you don't do that, most goods around the country are transported around, and this means those goods are going to be cheaper in the future. Energy prices in general are going down. So very good news in the months to come. It's basically like consumers are going to get a tax cut, if you will, in the form of lower gasoline prices. Now, the next chart I'm going to put up in a minute is called the Red Book Index, and it looks at retail sales growth for investors year over year. And it's a weekly chart, so we get recent data here. Now, the reason I'm showing you this is of late, there's been a concern, hey, the consumer may be headed for trouble. And we have heard this over and over and over in the last few years, and it hasn't turned out that way. Well, guess what? The consumers still have jobs. Yes, there are some layoffs taking place in the federal workforce last night, but the federal workforce, only 2% of jobs in this country, okay? So what's happening in the private sector is far more consequential, and we haven't seen signs that layoffs are really picking up steam there. So as long as a consumer has a job, they are spending money. And that's what this chart shows. The Red Book Index just came out today, and we're filming on a Tuesday. 6.6% year-over-year growth. And if you can look, this is over the last year. This is the 4th best week in the entire year of growth. That is very good news. And guess what? If you look at the last 5 or 6 weeks, this has been steadily heading higher each week. So it's very good to see consumers are still spending money. So my last chart in this rapid fire segment, and we are taking a look at an interest rate on a 10-year treasury bond. Listen, this is something that a lot of people don't love diving in the weeds, but this is super important to the markets. What you'll notice here, the 10-year treasury, and I want to focus on the last kind of 6-7 months. In September, this hit its low for the last couple of years at 3.6%. At the time, there was concerns about economic growth and that growth was really going to slow. Then in mid-September and the months following that, growth expectations started going up. And so the yield on a treasury started going higher and got all the way up to 4.8% in early January. And in our 2025 Outlook video, we said this was something that was a little bit of a concern to us if it kept going up above 5% and stayed there, because that would be more challenging for the economy in that case. And one example of that is mortgage rates are based on the interest rate on a 10-year treasury yield. So as an example, at the peak there in early January, mortgage rates were about 7.25%, up from about 6% late in the fall. Well, that put a freeze on housing. That is a very high mortgage rate. Well, here's the good news, because this rate has come down in the last 2 months. Mortgage rates have gone from 7.25% to 6.6%. We still hope they go lower than that, but this is very good news. And in general, the stock market over the last 10 years has done well when rates are coming down, long-term rates are coming down, and has struggled more when they're going up. So this move lower has been a positive. Now, let me speak about tariffs for a little bit, because that's been in the news lately, especially with 25% tariffs going on versus Canada and Mexico, and in China, tariffs going from 10 to 20%. And so that has been in the news. We did a video in early February where we spent 15 minutes just talking about tariffs. It was a standalone video. It wasn't a market update. And I would encourage you, if you're concerned about this topic, to go watch that video, because we take a really good look at this topic and about what you should think about it, because we said in that video, you're going to be hearing about tariffs quite often this year. It is not going away. Here's the key takeaway on it. In the long run, tariffs are just one issue, and you can't let that guide your decision making, because far more important is the combination of potentially lower tax rates, lower regulations, the fact that the consumer is still spending money, and the fact that companies are very upbeat and optimistic, including small businesses, the most optimistic they've been in decades. And so when you take the weight of evidence approach, that outweighs any concern tariffs may have. Go watch that video if you want to know more. Okay, so to recap, we talked about the fact that the stock market has not had a very good last 2 weeks, and these are never fun to go through, but yet they're a part of the markets, even bull markets. We looked at the fact that over the last 2 years and 2 months, the stock market has gone up significantly, but yet there were 5 sell-offs during that time. Not fun to go through, but that were part of what took place. We also looked at investor sentiment and the fact that in mid-December, investors were super bullish. They have flipped to super bearish, but that is not a bad thing. We like to see that. It lets us know the froth is out of the markets. In our rapid fire, we looked at oil prices near 4-year lows, and that is good news for consumer spending in the months ahead. We looked at Redbook and the fact that consumer spending up over 6% year over year. We like to see that. Lastly, we talked about the AI stocks. They've really led the decline, but we don't like to see bubbles out there, and the AI names were in a bubble. Well, that's it for today. And one parting note, if you are new to Sentara Capital, if you're managing your own investments or you have an advisor but you don't hear from your advisor, you can go to sentaracapital.com. You can reach out to us and have a conversation with a real person. If you're not sure if your portfolio is in the right place, now's a great time to call. Well, thanks for watching and take care.